What do you need in your investment toolkit? Well, first of all, of course, you need stocks. Nothing does better in the long run. And you probably also need some bonds. They're at least very much safer. You could put the two together, 60% stocks, 40% bonds, and that way you'll limit some of the pain when the stock market takes a dive. But there are limits to how far you can take this. Stock markets can go down and stay down for a very long time. We're showing you here the maximum times that stock markets around the world have been in negative territory since 1900. And you can see in the extreme case of Austria, which was on the losing side in 2 world wars during the 20th century, their stock market was actually in the red for 97 years. And while that's extreme, it's obviously the case in other markets that stock markets can stay down for as long as a human lifetime. You cannot rely on the long term to bail you out. Also, when it comes to investing in stocks, it turns out to be much harder than you would think it would be, and it's also much harder to find a manager to invest as well as he can for you. To go with a classic case, let's take a look at the Fidelity Magellan Fund, once the world's largest mutual fund. From 1970 to 1990, you can see that, helped by its famous investment manager Peter Lynch, it absolutely destroyed the S&P 500, the main index of the US stock market. But if we take a look at what's happened since then, you can see that it's very much come back down to earth. If you want another example, let's take a look at the Legg Mason Value Trust, as it was once known. It became very famous under its manager Bill Miller because he managed to beat the S&P 500 year after year very consistently. Once his streak broke, as you can see, the underperformance was so extreme that he went right back down to meet the index again. So, what can we do about this? Well, the critical thing is to limit costs. Active managers impose a burden upon themselves by spending money in their attempts to beat the index. Limit costs and simply track the index. The cheapest way to do this tends to be through an exchange-traded fund, or ETF. And as you can see, they have really taken off. Having only started 25 years ago, they now have some $3 trillion under assets around the world. Alternatively, you can try doing something very different from the stock market altogether, which would be to go into the hedge fund sector. Now, this was originally a sector that was held by regulators only for the very rich, for those who could afford to lose money, because it has various strategies which are an advantage but which do add to risk. They can leverage, in other words, they can invest money that they don't have, which can work out very well providing your investment goes up. They can sell short, which means they can bet on stocks to go down as well as up, and they can have very long periods. They can keep money locked up, which enables them to hold on to illiquid assets for a long time. As you can see, again, hedge funds have become very popular over time. They have almost $3 trillion in assets under management. Beyond hedge funds and alternatives, you could also take a look at commodities. And now very much regarded as a sector you should put in with others. There's some evidence that they can give you a strong return while not being correlated to the main stock market. They certainly don't always match it. Alternatively, you could look at real assets, currently very much in vogue. By real assets, we mean some tangible asset that will produce an income for you, like real estate or an infrastructure project. Now, how about putting all of these different investment tools together? If you use the magic of rebalancing, that's holding on to the same proportions throughout, you can do extremely well indeed. Rebalancing has the advantage that you tend to have to sell investments that have recently done well and to buy into investments that have recently done badly. That means you tend to sell at the top and buy at the bottom, which is exactly what you want to do. Here is an approach recommended by El-Erian, a very famous investor. This comes from research done by Meban Faber of Cambrian Asset Management. You can see his suggested asset allocation, and over 40 years he has done remarkably well. He's actually even managed to beat the stock market. Alternatively, you could try the permanent portfolio, which you can see here, much more conservative, as advocated by another very famous investor, Harry Brown. Over time, the final outcome of that, the ultimate performance of that, has been much less impressive, obviously, but it's given you a very, very much smoother ride. If you had wanted to take your money out at a time when the stock market had just taken a dive, that would have made a very big difference to you. So you can see that there are a number of very interesting asset allocation approaches using an investment toolkit that can really enhance your investment returns. However, there is one very important point that you must never forget, which is that nothing matters more than fees. Here we have another chart from Faber's research. If you take the El-Erian portfolio, which is the most successful portfolio looked at, and subtract a reasonable, sensible level of fees that you might often find yourself paying in the market, you can see that it will end up doing worse than the permanent portfolio, which in terms of return, not adjusted for risk, was the worst portfolio he looked at out of many. Ultimately, fees have the capability to turn what would otherwise be the best portfolio you had into the worst portfolio. So that, I think, is a critical message. There are a lot of extra tools in your investment toolkit these days. Those tools have indeed come into existence to meet genuine needs from investors, but there is still a strong tendency to make investment more complicated than it needs to be. Ultimately, I suspect that is to make it easier for investment advisors to justify charging fees for their advice, and those fees matter. Ultimately, nothing is more important when you're choosing the tools to use your investment toolkit than fees.